Thanks, Bill. And just very quickly in the way of an introduction, and thank you very much for staying with us this afternoon. It sounds like it's been a very interesting and lively discussion all day, so thanks very much for hanging in here with one of the last panels of the day. Just very quickly, Guardian is a regulated New York State-based life insurance company. Has only been in the private equity business actually for about 7 years. They recruited me 7 years ago to start this business for them. We have a very modest target asset allocation, and by modest I mean really small, 2.5%. You'll hear from some of the other investors here. New York State, for example, on the end of their allocation is much larger. When I was with the Michigan Retirement Systems, we had built that program over a 22-year period by the time I actually left. And we had a large allocation there, as most pension funds do. I had an allocation of 15%. So Guardian is, as I said, it's a regulated financial services company. And our mission in life, which Bill pointed out, that OPIC's mission in life is to take taxpayer-funded dollars, invest them properly and prudently, and actually, you're fortunate you've been able to actually make a return. Our expectation is that we have to invest for the return first, and that's in fact what we do. So private equity is really targeted just to essentially supplement what's otherwise a very heavily fixed income oriented portfolio, about 95%. Now in terms of emerging markets, one of the things that we wanted to do when we started this business at Guardian was to eventually, step by step, starting out with steps and then perhaps moving into a run or maybe a sprint later on as we've developed some experience for Guardian, was to start essentially with domestic markets and a little bit in Western Europe. And then in emerging markets, we've actually made an allocation of only about 7% of that 2.5% that I mentioned. So we actually do that through a fund-to-funds mechanism. And we have not at this point, again, as I said before, we have to start with small steps and then move into markets as they seem to fit the profile of Guardian's fiduciary responsibility to its policyholders. We have yet to make commitments to Africa. So we're not one of those institutional investors that have made that move yet. Second question, sorry, that's the intro, and sorry to move on very quickly, Bill, to your question about my specific experience in developing in emerging markets. I've actually been investing in developing markets and emerging markets back for almost 20 years, actually 17 or 18 years. And my experience goes back to Latin America in the mid to late 90s. And although I have my suit jacket on today, you'd see railroad track scars on my back from some of those early experiences. One common issue that I saw in those days, perhaps, and maybe if this can be transformed into wisdom, such that it is, and in terms of mistakes that have been made in the past, that those of you who are active in investing in the developing markets in Africa can perhaps learn from, and then fast forward and leapfrog across some of these issues was. One issue in particular was looking at the nature of small and even family-owned businesses. And hopefully there's some analogy here with the current markets in Africa. There were plenty of deals to invest in. There were plenty of great-looking little growth companies to buy and acquire. One of the issues that we discovered when we got on the ground was they didn't necessarily want to adopt the Western-style practices that we had established and had made sort of the mode of doing private equity and investing in private equity in certainly the U.S. and Western Europe. Taking on a partner to help grow and to help become a co-owner of a company was foreign concept to a lot of these, again, what would otherwise be great, terrific, targeted growth companies. And so that was one lesson learned. The other lesson that I think I would just pass along, and then I'll shut up and pass the mic here, is that business models that had worked, particularly platform buy and build roll-up strategies in the U.S., making an attempt to I guess, import or export that particular business model into a developing market simply was too far, too fast, and too much too early on. And so adopting the Western style of private equity, just because it's been successful in the U.S. and for the most part in Western Europe, isn't necessarily, I think, the right approach in a developing market, where I think in a lot of ways, and again, this is a bit of a parallel back with Latin America 15, 17 years ago, it's important to have development capital with, frankly, egalitarian motives and an economic development aspect, fueling the market at the same time that performance-driven, market-driven, return on investment-driven, let's call it fiduciary capital, is finding its way into the market at the same time. There's a lot to be learned by individuals and by investment professionals on both sides of the equation. So in a nutshell, those were just a couple of points, I think, that from my past experience, that hopefully there's some relevance and some utility value in knowing that about the African market. So.
No, thank you. Yeah, David, yeah. I mean, actually, the point on fiduciary capital, seeing more of the African pension funds investing in country and countries and regions. And you see the same thing in Latin America as well, as you know, with the pension in Mexico. I think that's a very growing trend. The
similarities with managers in a new market, developing market, frontier market, emerging market, however you want to describe it, and those that are in the more efficient side of this business, which we've all in some ways contributed to this higher degree of efficiency, is a GP and a manager has to be able to connect with the owners of the top companies that present the best prospects for eventually being able to develop that company into something more than it was, create value, know what to do with the company once they own it, once they're a partner in it, and really know what they're going to do with it to be able to create an exit event, to create a return on investment event. And so when I'm asked that question in conferences and in panels in the old established markets, my absolute #1 criteria for a manager is, can they generate enough deal flow to show that they're going to be able to invest the fund that they've so dutifully raised from folks such as ourselves on the panel here. So the similarities line up almost exactly. The one difference, and again, I'm sorry I have to digress and fall back on my experience in Latin America of the mid to late 90s, was creating a special relationship between the seller of the company and who they wanted to take on, because most of these deals were done as minority investments, and who they wanted to take on and what special characteristics, what special qualities they were looking for, and what level of trust they could actually engender in the manager themselves. We speak, as we should, very ardently about our fiduciary responsibilities, but it's creating this relationship, it's creating this special partnership between the manager and the owner of a company and the seller of a company that really has to transcend whether it's a developed market or an emerging market. And so when that characteristic, when that capability to create that special bond with a full understanding that they have a mission in mind, which is to build value in a company, that's a characteristic that I'm guessing exists in a number of the probably the top and attractive GPs that are on the ground in Africa at this point. Certainly hope there are anyway. And when I get there eventually, that's what I hope to see. So.
Thanks, David.
Doing business in Africa. You can't afford to be without Africa Investor.